yesterday wasn't completely unexpected because they had already mentioned that they were going to do some buying in the secondary market, in the bond market. So the fact that some people were skeptical, it proved that they would do what they said, but it wasn't new news. Now today, with his testifying today being Tuesday, things are shifting a little bit. The market right now has sold off, but yet is still up on the day, mainly because he's talking, I think, in a more reality type of sense. Number one, he's saying that there's going to be millions of people out of work for a really long time, and that's true. There will be aftershocks, is the word that he used. That in terms of the yield curve, they're looking for the Fed to actually be able to change the yield curve by going negative rates, and he's saying he's not ready to do that. And he's really thinking more that the economy is going to take a while to bounce back, where you have all these economists from the big companies like Morgan Stanley saying we're in a V-shaped economy. So in essence, he's saying what we say here in the United States is talking from both sides of his mouth. He's willing to do whatever it takes, but on the other hand, he's got some concerns. But here in the United States, they're not talking about closing down at all. They're going to leave everything open. So it's going to be up to the consumer to decide what he or she wants to do. And with the fact that we are actually seeing an increase in cases right now, that is a huge concern, because if everything's open but nobody shows up, that's not very good for the economy at all. And we're seeing that reflected in the market. Even though NASDAQ went crazy and the S&P 500 went crazy, it's really being driven by tech, particularly, as you say, tech that helps people stay at home, and biotech, which of course is because of the hope of not only vaccine, but now they said that they have had some good trials in terms of dealing with some of the symptoms that lead to death with the virus. But the rest of the market has been dragged up, but still showing a lot of stress. And that's really what would concern me, like for transportation and the financial system. And even though the retail sector got a boost today from an increased retail sales, you know, that's 1 month to the next, and that's also a more of a back-looking type of statistic, not necessarily a forward-looking statistic. So the optimism might be out of the market for now. I think the commodities market is the future for so many different reasons, but I'm looking at not necessarily a hyperinflation scenario, but more of a stagflation scenario, which simply means the economy stagnates while inflation increases. And so, for example, this helicopter money that the Fed is doing and continues to do and says that they will continue to do is a reason to think that we will see a stagflation environment. So we have been long some of the commodities. I know last week we talked about copper. And copper is an interesting commodity because it's an inflationary indicator, but it also has to do with real economic growth, as in home building. It's holding and needs to continue to hold last week's lows. So that's one commodity. If you look at strictly speculative inflation type of indicators, you've got to look to gold. I mean, that's really the major, I think, instrument that will really tell us whether or not we're heading to a more inflationary path. And even though the dollar has firmed a little bit, it's still relatively weak. Even though the yields have firmed a little bit today, they have still been very, very low. And because of the fears, not only of just raw material prices going up, food hoarding, and supply chain disruptions, gold has really held up well. And I think you're just going to need one little trigger to ignite it up to that 2,000 and maybe even higher.